Opendoor Technologies, trading under the ticker OPEN, is currently priced at $8.90, reflecting a significant intraday drop of 4.20%. This sharp decline in a single trading session might seem alarming, and frankly, it diverges sharply from the optimistic narrative that has propelled the stock over 400% higher year-to-date. The common perception is that Opendoor, as a trailblazer in the iBuying space, is on a clear path to dominating the real estate market. However, the reality of its current situation is far more nuanced, presenting a complex picture of high-stakes risk and potential reward that the broad market seems to be overlooking in its enthusiasm. What's truly at play here is not just a simple story of a tech company disrupting an old industry, but a high-wire act performed against the backdrop of a volatile housing market and shifting investor sentiment, something many retail investors using platforms like Robinhood or SoFi Invest might not fully appreciate. The expectation surrounding Opendoor has been largely fueled by its aggressive growth and its promise to simplify the home buying and selling process. The idea of a frictionless real estate transaction is undeniably appealing, and Opendoor has positioned itself as the go-to platform for this modern approach. This has attracted a wave of investors, from large institutions to individual traders, all betting on the company's ability to scale its operations and achieve profitability. Many look at the recent leadership changes with the appointment of 𝐒𝐞𝐫𝐞 as the new CEO and see a renewed focus on innovation and efficiency. The recent buzz around the potential integration of cryptocurrency for home purchases has only added to this speculative fervor. However, the reality is that Opendoor's path is fraught with challenges that could derail this optimistic trajectory. The company is navigating a housing market characterized by stubbornly high mortgage rates, which has dampened affordability and slowed transaction volumes. This directly impacts Opendoor's ability to buy and sell homes at a profitable margin. The iBuying model is inherently capital-intensive, requiring Opendoor to hold a significant inventory of homes, making it vulnerable to downturns in home prices. While the company has made strides in improving its operational efficiency and reducing costs, the specter of a housing market correction looms large. This tension between the market's expectation of unchecked growth and the harsh realities of the real estate cycle is the central theme that will define Opendoor's future. A closer look at Opendoor's recent stock movement reveals a story of intense volatility. The stock has experienced dramatic swings, often driven by broader market sentiment rather than company-specific news. High trading volumes on days with significant price movements suggest that both institutional and retail investors are actively trading the stock, creating a dynamic and often unpredictable environment. The recent decline, for instance, could be attributed to a number of factors, including profit-taking after a massive run-up, concerns about the upcoming earnings report, or a broader market downturn. Institutional ownership, while still significant, has seen some notable changes, with some large funds reducing their positions, while others have initiated new stakes. This divergence in institutional sentiment highlights the lack of consensus on the company's long-term prospects. For investors using platforms like Fidelity or Interactive Brokers, which offer more in-depth research and analysis tools, the conflicting analyst ratings are particularly telling. While some analysts maintain a buy rating, citing the company's long-term growth potential, a growing number have downgraded the stock to hold or even sell, pointing to the near-term headwinds in the housing market and concerns about the company's path to profitability. This wide dispersion in analyst opinions underscores the uncertainty surrounding the stock and the difficulty in accurately valuing a company that is still in its early stages of disrupting a massive and complex industry. Opendoor's business model is centered on the concept of iBuying, or instant buying. The company uses proprietary algorithms to value homes and make all-cash offers to sellers, aiming to provide a faster and more convenient alternative to the traditional real estate transaction. Once a home is purchased, Opendoor makes necessary repairs and renovations before listing it for sale on the open market. The company generates revenue from the service fee it charges sellers and the appreciation in home prices between the time of purchase and sale. This model can be highly profitable in a rising housing market, but it also exposes the company to significant risk in a declining or stagnant market. Past performance is a mixed bag. While Opendoor has demonstrated its ability to rapidly grow its revenue and transaction volume, it has also incurred significant losses. The company's financial reports show a history of negative earnings per share and a challenging path to sustained profitability. Older reports and past performance highlight the cyclical nature of the real estate market and its impact on Opendoor's financial results. In periods of strong housing demand and rising prices, the company has been able to generate impressive growth. However, in periods of market weakness, it has struggled with inventory write-downs and declining margins. This history of volatility is a critical factor for investors to consider, as it suggests that the company's future performance will be closely tied to the health of the broader housing market. Looking ahead, the future for Opendoor is a tale of two potential narratives. In one scenario, the housing market stabilizes, mortgage rates decline, and Opendoor is able to leverage its technology and operational improvements to achieve sustained profitability. In this best-case scenario, the company's stock could see significant upside as it captures a larger share of the massive U.S. residential real estate market. The company's expansion into new markets, the development of ancillary services, and the potential for new revenue streams could all contribute to its long-term growth. The recent announcement of a $200 million share buyback program is a sign of management's confidence in this positive outlook. However, there is also a more bearish scenario to consider. If the housing market continues to face headwinds, with high interest rates and declining affordability, Opendoor could struggle to maintain its growth trajectory. The company's inventory of homes could become a liability, forcing it to sell at a loss and further impacting its profitability. The competitive landscape is also a factor to consider. While Opendoor is a leader in the iBuying space, it faces competition from both traditional real estate companies and other tech-enabled platforms. The ability to differentiate itself and maintain a competitive advantage will be crucial for its long-term success. The debate between these two outlooks is what makes Opendoor such a compelling and controversial stock. On one hand, you have the bulls who believe in the company's disruptive potential and its ability to overcome the challenges in the housing market. They point to the company's strong brand, its technological advantage, and its experienced management team as reasons for optimism. They see the current stock price as an attractive entry point for a long-term investment. On the other hand, you have the bears, who are more cautious about the company's prospects. They point to the company's history of losses, its vulnerability to the housing market, and the intense competition in the real estate industry as reasons for concern. They believe that the stock is overvalued and that there is significant downside risk. This dichotomy is what fuels the high trading volume and the sharp price swings that we've seen in the stock. It's a classic battle between expectation and reality, between the promise of a bright future and the challenges of the present. For those considering an investment in Opendoor, it's crucial to understand both sides of the argument and to have a clear thesis for why you believe the stock will either succeed or fail. Comment below with your take on the housing market. Do you see a recovery on the horizon, or are we in for a prolonged downturn? Ultimately, the story of Opendoor is still being written. The company has a bold vision and a talented team, but it also faces significant challenges. The recent stock performance, with its dramatic rise and subsequent pullback, is a reflection of the market's uncertainty about the company's future. The expectation of a seamless, tech-driven real estate experience is a powerful one, but the reality of the housing market is a formidable obstacle. For investors, the key will be to look beyond the short-term noise and to focus on the long-term fundamentals. This means carefully analyzing the company's financial performance, its competitive position, and its ability to adapt to a changing market. It also means having a clear understanding of the risks involved and being prepared for the volatility that is likely to continue in the months and years ahead. Whether Opendoor will ultimately live up to the high expectations that have been set for it remains to be seen. But one thing is certain, it will be a fascinating story to watch. The company's journey will not only determine the fate of its investors, but will also have a profound impact on the future of the real estate industry as a whole. The tension between the promise of disruption and the realities of a deeply entrenched industry is what makes Opendoor one of the most interesting and talked about stocks in the market today.